Hi guys, welcome back to my channel. Kelvin here. In this video, I'll be giving you a step-by-step guide on how to start investing, like what should be your mindset, how to choose your stock, what should be your strategy, all the good stuff which I wish my younger self had known earlier. For beginners, investing sounds complicated and risky, and with all those stories you heard about people losing money in the stock market and jumping off tall buildings, it can be seriously scary. That's how I felt when I started investing just 4 years ago, and I wish that there was a video that could show me the right way to invest so that I wouldn't make all those stupid mistakes and lose money. After this video, you will gain the knowledge to travel the dark, dangerous, scary path of investing. Just kidding, investing is not scary at all if you know what you are doing. Anyway, there's a lot to talk about, so let's start right now. Before you start investing, you have to know that investing is just putting your hard-earned money into something like stocks and hoping that it will grow. But if you anyhow choose a stock, it will be similar to buying lotteries, which if you often win at buying lotteries, you are called God of Gamblers, 赌神. But if you often win at investing, you are called God of Stocks, 股神. Before you start investing, here are the habits that you should have. Number 1. Pay yourself first. Investing is like going to the gym. You don't go to the gym once, bench press a few times, go home and expect to see a six-pack, right? It must be consistent and long enough to see the result. Every month, pay yourself first by setting aside a sum of money for investing. You'll be like, but I do pay myself first. I treat myself to Pao Pao Cha and buy nice clothes for myself. That's not paying yourself first, that's paying the Pao Pao Cha shop owner first. Paying yourself first means leaving aside a sum of money for yourself so that it will benefit your future self. I don't care how little it is, it can be as little as $100. The key is to be consistent. Second, start investing as early as possible. The earlier you invest, the more risk you can take. Imagine you start investing at 18 years old, investing $100 every month. Even if you lose all that money, at the very most, you won't be able to afford Starbucks for a month. But when you start at 40 years old, you can't afford to lose. You have a wife, a house, a kid, a goldfish, and an upcoming retirement. And if you lose all that money, your wife will ask you to kneel on the keyboard. We don't want that now. On top of that, by investing early, you will unlock the power of compounding, which is the longer you invest, the faster your money will grow exponentially. Here's an example from TD Ameritrade. If you start investing at 21 years old, after 46 years, your investment will be over $470,000. But if you start at 47 years old, your money won't grow as much. Which brings me to my next point. What type of stocks should you choose? If earning money is your goal, then investing is like riding a vehicle to reach that goal. You can choose an investment like bonds, which is like riding a bicycle. It is super safe and you can slowly ride to your destination, but you will take a very long time to reach your goal. Or you can choose stock trading, which is like riding a PMD on the highway while playing Xiamju music against oncoming traffic. You will get to your destination much quicker, but that requires skill to avoid all the cars and you can easily make mistakes and lose money. There are many more types of investments like dividend stocks, index funds, mutual funds, cryptocurrency, forex. In this video, I want to share with you which investment type I think is good, and by good, it must fulfill a certain criteria. First, it must be low risk, which means that the chance of losing money must be as low as possible. You don't want to be hit by oncoming traffic, riding PMD while playing your Xiamju music. So with this, stock trading, cryptocurrency, forex are all out. Second, it must be low fees. You don't want to earn a lot of money but pay 2 to 3% worth of commissions every year. It's like driving a big car, but that car is not fuel efficient. That wouldn't be good, right? So with this, mutual funds is out. Third, it must give me the highest return possible. And I'm talking at least the S&P 500 return, which was 10% annualized over 90 years. Sure, if you ride your bike from Jurong to Changi Airport, you can reach your destination safely. But by the time you reach, it will be 500 years later. So with this, bond is out. That just leaves us with index fund and dividend stocks. Let's talk about index funds first. For anyone who doesn't know, index funds is just a basket of stocks representing a certain sector, like a basket of US stocks or a basket of technology stocks. So instead of buying one stock, by buying into an index fund, you own a whole bunch of stocks. Here's an example. Imagine you are in a Pokemon tournament. You can pick this Pokemon, which is it is Pikachu. You pick Pikachu to fight, but if it gets wiped out, you will lose the whole tournament. Instead, here's what you can do. you can combine a whole bunch of Pokemon to fight instead. Even if Pikachu loses, you still have 1000 other Pokemons to fight, essentially lowering the chance that you will lose. A real-world example is buying into the S&P 500 index fund. You are betting that United States as a whole will do well in the future. Or if you are buying into the healthcare index fund, you are betting that the entire healthcare sector, including biotech, pharmaceuticals, medical equipment, everything will do well in the future. Now, there are lots of benefits for buying into an index fund. First, well diversified. By buying into an index fund, you own a small percentage of each stock in that sector. Even if one stock doesn't do well, you still have a whole bunch of other stocks to boost your performance. Second, self-cleansing. One of the criteria to be included into the S&P 500 is that companies must be profitable for 4 quarters. So if any company were to underperform for too long, it will be kicked out and replaced with another better company. So by buying into an index fund, your portfolio will be improved automatically. You won't have to manage it yourself. Third, same performance as the market. As mentioned earlier, the S&P 500 had averaged around 10% over the long term. Meanwhile, eToro found that 75% of traders lose money. A research by Dalba found that average equity fund investors only earn a market return of 5.19%. And it was found out that over the long term, active fund managers underperform the S&P 500. As you can see, a lot of people cannot beat the market. As the saying goes, if you cannot beat them, eat them. Wait, that's the wrong quote. The right one is, if you cannot beat them, join them. Rather than trying to outperform the market, just buy into an index fund and get the market's return. For S&P 500, you could just invest in WUSA. Or if you want more alternatives, I've already done a video showing which index funds are good. Link in description below. So if you want a safe investment, do not want to manage your portfolio, and want to save on management fee, go for index funds. Now for my other favorite, dividend stocks. Dividend stocks is just like what the name is, a stock that pays dividends. A benefit of dividend paying stocks is that it is generally safer than non-dividend paying stocks, because people don't generally trade dividend stocks as much, making it less volatile. Another benefit is dividend investors rely on dividends to earn money, rather than on stock prices. This makes them more immune to stock market fluctuations. So imagine this, if you are nearing retirement and you own a non-dividend paying stock, maybe Tesla. If Tesla crashed by 50% and you need to sell it to fund your retirement, then you have lesser 50% to use. But instead, if you own a dividend stock, even if the market crashed, it doesn't matter, because if the company is strong, like maybe Coca-Cola, you will still get paid dividends no matter what. On top of that, dividends generally do not drop as much as stock prices. A study called Why Dividends Matter found that over the past 5 US recessions, dividends per share do not drop as much as earnings per share. Like during the 1970s recession, dividend per share only dropped by 1%, while earnings per share dropped by 15%. 1981, dividend per share didn't drop at all, while earnings per share dropped by 19%. Even during the 2007 recession, dividend dropped by 24%, while earnings per share dropped by over 90%. So if you want a safe and steady return, invest in dividend paying stocks. I have a subscriber who asked this question. Could you do a video detailing what's your thought process in shortlisting and ultimately buying a stock? That's actually a very good question, because when I first started investing, I didn't think too much about that. All I see are just stock prices, and investment articles didn't really help a lot. Like, should you be buying this growth stock? Here's what you need to know about that stock. Don't get me wrong, these are all very good articles, but if you are new to investing, all this will sound like French to you, like bonjour, croissant. So here's my thought process when buying a dividend stock. First, can the management continuously increase their dividend? If you are investing, treat your money like your employee. Now, just like you, your money must get a pay raise every year. Here's an example. First REIT. A hospital REIT with 11% dividend. Looks good? Let's check whether the dividends increase annually or not. As you can see, from 2017 till 2019, the company dividend has stuck at 0.086 cents. Imagine working at the same job for 3 years and not getting a pay raise. That would suck, right? And that's one of the reasons why the stock price has been dropping. First REIT. The reason a company can increase its dividend is because it has a capable management that continuously look for ways to earn more money. Let's look at Mapletree Logistics, around 4% yield. Dividend has been consistently increasing throughout the years. That's because they have been constantly acquiring new assets. How about capital more? Their yield have been increasing, which is good, but they haven't been acquiring new assets recently and doesn't have plans to expand overseas, which you might have guessed they won't be able to increase their dividends as fast in the future. So when investing in dividend stocks, always make sure that the company can continuously increase its dividends. Otherwise, your return would be sucky. Second, when choosing a dividend stock, I will always ask, does the company has a moat? You might ask, what is a moat? 可以吃的吗? If you watch Game of Thrones, this is a moat. It protects the castle from enemies. A moat can be anything. It can be a brand name or barrier to entry. For example, if I say soda drink, you think of Coca-Cola, not Pepsi. If I say burgers, you think of McDonald's and not Burger King. Or if I say chocolate drink, you think of Milo. Yes, that Milo which you and I have drank for 25 years and is still not a champion yet, Milo. But if I say airplanes, you won't have a preference. Some will take AirAsia, some Scoot, some Tiger, some take Singapore Airlines or SQ, where the air stewardess say, "Excuse me, excuse me." Jokes aside, we will always choose the plane ticket that is the cheapest. That's why there is no mode in airplanes. If I say telco, some will say Singtel, some M1 or StarHub or Circus Life. Again, you see that there is no mode in telcos. What about BreakTalk, a bakery that makes bread that can talk? Again, no mode because any bakery can just come along and make a better bread. Companies without a mode will not be strong, and any company that is not strong will eventually be replaced. That's what happened to Nokia. When Apple and Samsung came along, Nokia just died. So then what are the companies that have a strong mode? Banks like DBS, UOB, tech companies like Google, Facebook, Apple, healthcare companies like P&G. You know, things that all of us use on a daily basis, and because of that, their mode is very strong. Here's how you can find good dividend stocks. First, use a stock screener. Check this video here where I give all the financial criteria on choosing a good dividend stock. Basically, it is low debt, high earnings, good dividend payout. Or you can also choose from the stock list like STI ETF if you want Singapore stocks, KLSI if you want Malaysia stocks, or S&P 500 if you want US stocks. Then filter from there. Or even look at other people's portfolio online, like my stock portfolio. See what they say about their stocks. Is it good or is it bad? After you shortlisted, research about the company as much as possible. Like, what are their future plans? Do they have a moat? It's like you match someone on Tinder. You want to know about the person as much as possible. So you CSI her. Like, what's her full name? What's her height? What's her blood type? What do you mean it's creepy? Jokes aside, here's a very good trick. Check out forums or YouTube videos on what everyone thinks about a certain stock. For Singapore forums, you could read Hardware Zone or Investing Note. For Malaysia forums, you could check out Lawyat or i3investor.com. Those are just some of the forums, otherwise you can just Google it. So that's how you choose a dividend stock. Company that continuously expand and has a moat. Now that you know you can invest in dividend stock and index fund, what should be your investing strategy? First, as I've mentioned earlier in this video, pay yourself first. Set aside some money for investing every month. Second, have a shopping list ready, like what stocks you are interested to buy. Third, pick a stock from the shopping list to buy, like maybe this stock has the best dividend yield of the month, so I will buy this stock. Or maybe this stock weightage is too low in my portfolio, so I will buy more to increase the weightage. Consistently do these 3 steps, just buy and hold, buy and hold. Even if a crash comes, don't panic sell. Treat it as a grand Singapore sales and just buy more stocks. If you can keep doing this, you will be a successful investor. And going forward, how should you learn about investing? Many people recommend reading investment books like One Out of Wall Street, Intelligent Investor, and Essays of Warren Buffett. But here's my opinion. If you are new to investing, skip all these books altogether. I've tried reading them and I find them super dry, like Asahi. Don't get me wrong, these are all good investment books. But you should only read them when you have certain experience in investing. Also, don't go for investing courses. You don't have to pay hundreds or thousands of dollars just to learn stuff that is easily available for free online. Watch my videos or any other investing YouTube videos. Read investing articles from Sydney. Join forums like Hardware Zone, Reddit, or even Telegram to join stock discussions. That way, you'll get more investing information in a much more fun way. Investing shouldn't be stressful. It should be fun, yeah? And that's all for today. Let me know in the comments down below if you have any questions. Like, share and subscribe as I'll be posting new videos every Monday. See ya!